Hi there, welcome to the latest Brunsdon Financial Services market update. We're pleased to have with us this morning Jonathan Webster-Smith from Brooks Macdonald, who is both a director and also head of the asset management team. Jonathan and his team looks after the Brunsdon IFSL investment funds, and we're here today to ask about how markets are performing and how indeed the funds themselves are performing. Jonathan, these are very interesting investment markets to say the least. What with Brexit forever on the agenda, Donald Trump now 100 days in power, we've got the general election looming, and of course in France, with Macron just being elected as president, one starts to wonder where the investment markets are moving. There tends to be four main questions that we get asked by our clients, and I wonder if we could just have a look at those individually. Then let's look at the very first question we tend to get asked a lot. One is about inflation and of course the impact on prices. I wonder what your thoughts are on that.
Yeah, I mean it's certainly one of the topical questions that we're being asked very regularly, given the latest inflation figures showing that UK inflation is now above 2% and has been for a while. It really, I mean, it hasn't been an issue historically, given where inflation has been. But what happened last year, following the Brexit vote, is when the UK exchange rate depreciated, and therefore it's made food prices in particular more expensive, given that we import such a high percentage of our food. This is therefore having a knock-on impact to clients' savings. Clearly, with cash rates where they are, they're in effect getting a real loss. That is to say that inflation is running at a higher level than cash at bank, and therefore it's making the impact on prices so strong and so important. And that's where investing your money in the right asset class at the right time is so important. And that's of course what we're trying to do through both the Brunsdon Cautious and the Brunsdon Adventurous Fund, and that is to provide investors a real return over a number of years.
So in particular, following the news from France, has the political risk in Europe reduced in any way?
I think the easy answer and the right answer is yes, it has, following the election of Macron. I think if we look back at the events of the French election, it was a very clear race between Macron and Le Pen, and what the evidence and the polls are showing is that it was going to be very hard for Le Pen to actually win, given none of her votes were transferable. While she did very well in the first round of the election, it was very unlikely that she was going to succeed in the second due to the transferability of the votes. And what you've seen from a stock market perspective, as well as supported by improving numbers out of Europe, but the more political certainty we have now, because Macron is clearly a pro-European. The elections in Germany that are upcoming are also looking very much like a pro-European party is going to get the majority or the required number of seats there, and that does help give you that greater political stability in Europe. From a stock market perspective, and particularly if we look at it relative perhaps to the US market, you can actually see the European market has been and still is cheaper on a relative basis than the US, and that's one of the reasons why we've been increasing our weightings to Europe, and indeed have done so ahead of the election, given we felt that was the output, and clearly that's had a very positive impact on returns. But certainly I believe that whilst there is always political uncertainty, we should of course remember that the Italian elections are coming up, but they have changed governments a large number of times post the World War. You know, they have these things far more frequently than any other European country. So it's definitely not gone away, but I feel that the political risk is certainly lighter or less than it was pre the election. But of course the French House elections are coming up, and those remain very important to see how far Macron can pursue his policy. So it's not gone, but it's definitely a more pro-EU stance. And as the economic data in Europe, of course people move naturally back away from the extremism, and you're seeing that in the jobs data that's improving as well. So overall, I think it's a more positive and improving picture in Europe.
Another key question, Jonathan, we get asked quite often is about interest rates, and the two key ones that affect us, of course, is both in the US and of course the UK. I wonder what your thoughts are on where you see interest rates going for the future.
I think it's a relatively easy question to answer, in the sense that I think it's fair to say that in the developed world, so the US, Europe, the UK, and following that in Europe, I think we would expect to see rates increase from where they are now. So that's not a particularly controversial statement. We're obviously currently going through rate rises in America at the moment, and indeed all the economists have pointed to a near certainty of interest rate rises, an interest rate rise in June for the US. Where they go after that, of course, there is not that consistency of answer, in the sense that polls are split between whether you get 2 or 3 rate rises. But the unquestionable view is that rate rises will continue in the US. We don't have the certainty around the number of rate rises. I think if you look at the UK market, we wouldn't expect a rate rise this year. Certainly the evidence and the opinion is pointing to early rises throughout 2018. But again, that will be very much, as was the US, data dependent. So if the data continues to improve and be positive, then clearly there's room for interest rate rises within this country. But clearly we need to be cognizant that is data dependent, what happens over the next 12 months. Also, we would expect, and we are expecting, quantitative easing announcements in Europe. They're obviously still going through the quantitative easing, and whether they stop. I think they would stop first, and then obviously there'll be a pause before we see European rate rises go. The caveat from the UK perspective is obviously, as inflation is already at is over 2%. Clearly, if inflation was to move higher, then I think that might force the Bank of England to move faster. I don't believe that we're in that position, and if anything, I think you'd probably expect to see inflation tail away, particularly as we've seen a little bit of strength in sterling, which will obviously help our imported inflation, and the evidence is wage demands are not necessarily coming through this year. So I don't see that, although that is one case where the Bank of England may be forced to raise rates quicker if inflation did come through. If inflation softens, I think you may well see UK interest rates potentially be pushed out a little bit further to allow the economy time to recover. And of course, we are going through the Brexit negotiations, which adds a little layer of uncertainty. So again, I would be more in the camp of a slower UK interest rate rises. I actually believe the US will continue to push through with theirs, and probably expect to see one more towards the end of this year, or indeed the early part of next year.
The other key question that we get asked, of course, is about the UK general election and what may or may not happen. How does that affect investment markets?
Calling the general election came a little bit out of the blue, as I believe it was 11 times since she's come to power. She said she won't call a general election. Her reasoning, and it seems very logical, is that there's too many different opinions around Brexit. So I believe she wants a mandate from the country to strengthen her negotiating position in Europe, and it seems from the evidence so far that she would win perhaps an increased majority, and therefore a stronger UK government will materialise as a result of this. That can potentially only be more, that should only be more positive from the economy's point of view, giving us a stronger negotiating position. However, we've seen polls have been wrong before, so we probably can't make any expectation as to what the end result will be. But nevertheless, it does, from an investment point of view, it's very difficult for us to make decisions around what is an unknown result. And whoever wins power, you would hope has the best interests of the UK and the UK economy. So from a stock market perspective, we're not going to be making any changes on the back of what we think the vote may or may not result in. We'll carry on with our strategy, which is based around taking a given level of risk to maximise the return, and we believe we're on track. And politics and political cycles will occur around people's investing, but in this case I think it's going to strengthen the Conservative hand, and therefore I probably we won't need to make any changes. The sterling has strengthened on the result, as is a belief that actually it will force a slightly softer Brexit. I'll put that in inverted commas, as we're not hard and soft, it's very hard to distinguish. But clearly, we simply don't know what the outcome of that will be. And as the negotiations go through, we'll clearly have to monitor that. But it certainly did surprise the market, as these things often do.
Thank you, Jonathan. That was really interesting and positive, good news for the future. Thank you for watching the Brunston Market Update. I hope you found that both interesting and informative. Some good positive news up ahead. If you have any questions, as always, please be in touch with your normal Brunston consultant or any member of the Brunston team, and see you again next time. Thank you.